There's this really strange phenomenon in the crypto world, this mysterious price level that seems to act like a ghost or like a spooky magnet, just pulling the market towards it no matter what else is going on.
I bet you've seen it happen. A huge rally or a sharp drop just stops on a dime. It reverses at a price that makes no sense. It's not a support line, it's not a resistance line, it just goes there. It's almost like it's market destiny. Well, we're about to find out what's really behind it.
So, to solve this mystery, we're going to break it down into 4 key parts. First, we'll unmask the market giant that's pulling the strings. Then, we'll see exactly how these price gaps are born. After that, we'll feel their magnetic pull. And finally, we're going to bust the biggest myth about them.
Okay, let's start with our number one suspect, a giant from the world of traditional finance that, believe it or not, plays a massive and often hidden role in crypto.
And that giant is the CME, the Chicago Mercantile Exchange. You got to think of this place as the major leagues of trading. This is not just another crypto exchange. We're talking about the world's largest, most heavily regulated futures market. This is where the big shot institutions trade everything from corn and oil to, you guessed it, Bitcoin.
So, why should we care so much about what the CME does? Well, unlike a lot of the 24/7 crypto exchanges where volume can be faked with stuff like wash trading, every single trade on the CME is legit. It's regulated, it's taxed, it's totally transparent. That means every dollar of volume you see is real money. And for serious traders, that makes it a super high-quality signal.
And hey, the numbers don't lie. Just look at this. In early 2024, the open interest, which is just the total value of all the open contracts on CME Bitcoin futures, was nearly $3.6 billion. That's right on the heels of Binance, which is the biggest crypto exchange out there. This shows you the CME is a massive player with a very powerful voice in this market.
Okay, so we know who the giant is. Now, how in the world does this giant create those weird gaps on the chart? Well, the answer is actually surprisingly simple.
It all comes down to one thing: trading hours. See, the CME, it works like an old-school market. It trades Monday to Friday, and then it shuts down for the weekend. But as we all know, crypto never ever sleeps. It's a 24/7 party. And that difference, that's where the magic, or the gap, happens.
Let me walk you through it. Picture this. It's Friday afternoon, the closing bell rings, and the CME closes at a specific price. But all weekend long, the crypto world keeps on trading, pushing the price up or down. Then, Monday morning rolls around, the CME opens back up, and its price has to instantly jump to wherever the market is now. And that jump leaves a blank space, a gap, on the chart, between Friday's close and Monday's open.
Okay, so we get what a gap is and how it's made, but why does it seem to have this strange magnetic pull on the price? What are traders actually looking at when one of these things pops up on their screen?
This right here is the core idea that so many traders follow. That gap is seen as a point of unfinished business, a price level with like a gravitational pull. The theory is that the market just feels this need to go back to that untested zone and fill the gap. So the really important part is watching how the price reacts when it gets there. If the price goes back to the gap and then bounces off it, finds support or resistance, traders see that as a big sign that the trend might be about to reverse. But what if the price just blasts right through it like it's not even there? Well, that signals the trend is incredibly strong and it is not stopping for anything.
All right, now for the biggest misconception. And this is really the final piece of the puzzle. Is filling a CME gap a sure thing? Is it like a law of the market?
It's a really tempting idea, isn't it? If there's a gap on the chart, the price has to go back and fill it, 100% of the time. Simple. But is it actually true?
No, not at all. A much better way to think about it is like gravity. A gap that's close by has a really strong pull, and it'll probably attract the price. But a gap that's super far away from where we're trading now, its gravitational pull is so weak that the market might just never go back. And if you need a perfect example, here it is. This is the ultimate proof. This price level, around $9,600, is the most famous unfilled CME gap in Bitcoin history. The market left it in the dust years ago and has never even thought about going back.
And hey, Bitcoin's not the only one. Ethereum also has a big unfilled gap just hanging out around the $1,700 mark. These things are a constant reminder that in trading, there are absolutely no guarantees.
So what's the bottom line here? CME gaps are a fascinating and, a powerful tool for analysis. They show you where the big, regulated institutional money sees points of interest, but they are not a crystal ball. They are not a guaranteed trading signal. Think of them as a clue, not a conclusion.
So that spooky magnet? Turns out it's not a ghost after all. It's just the footprint left behind by a sleeping giant. Now you know its secret. The real question is for you to decide. Is it a reliable map that can guide you, or is it just a market mirage?